If you're waiting for your mortgage to come down, I think you need to hear this. Because over the last couple of weeks, something has started happening in the financial markets that could affect mortgage rates, government borrowing, the Bank of England, stock markets, and yeah, even Bitcoin. Now, I know that sounds like I'm trying to connect a lot of things together that don't belong. A mortgage has nothing to do with Bitcoin, the Bank of England has nothing to do with oil prices, and Japan? Well, what does Japan have to do with anything that's happening here in Britain? At first glance, absolutely nothing. But by the end of this video, I want to convince you that all of these stories are connected. In fact, I think they're all pointing towards the same thing. And if that's true, it could completely change the way you think about markets. Welcome back, everybody. I'm Paula. If you've watched the channel for a while, you'll know that I love trying to connect stories that are normally reported separately. Most news stories tell you what happened, but what interests me is why it happened. Because markets rarely move because of one headline, they usually move because lots of different things slowly began pointing in the same direction. And I think that's exactly what's happening today. Let's start with the UK. Over the past few days, UK government borrowing costs have started climbing again. You may have seen headlines saying that 10-year gilt yields are approaching 5%. Now, I'll be honest with you, a few years ago, if somebody had started to talk to me about gilt yields, I probably would have switched off. It sounds technical, it sounds like the sort of thing economics discuss on Bloomberg, while the rest of us wonder why our weekly food shop keeps getting more expensive. But here's what I've realised. The bond market isn't boring. The bond market is where money tells the truth. Governments can make promises. Politicians can stand behind podiums and announce new spending. Central banks can tell us inflation is coming down or that everything is under control. The bond market doesn't listen to speeches. It simply decides whether it believes them. So, let's keep this really simple. A gilt is just a loan. When the UK government needs money, it issues bonds. Investors buy these bonds, and in return, the government agrees to pay them interest over a number of years. The yield is simply the return investors demand before they're willing to lend their money. If investors become more confident, they'll accept a lower return. If they become more nervous, they'll demand a higher one. That's why rising yields matter. They're the market's way of saying, we think lending money has become more expensive. Now, here's the important bit. This doesn't stay inside the bond market. If government borrowing becomes more expensive, banks often end up paying more to borrow too. Those costs eventually work their way into fixed mortgage rates. Businesses face higher borrowing costs. The government has to spend more servicing its debt, leaving less money available for other priorities. So when bond yields move, they don't just affect traders sitting in the City of London. Eventually, they affect almost all of us. And that's why I think this story deserves a lot more attention than it's getting. The obvious question is, why are yields rising now? Well, if you read the headlines this week, you probably conclude it's because of what's happening in the Middle East. Renewed tensions involving Iran pushed oil prices higher. Right now, that might not sound like a huge deal, but around 20% of the world's traded oil passes through the Straits of Hormuz. Whenever markets worry that that route could be disrupted, oil prices usually react very quickly. And higher oil prices don't just affect people filling up their cars. They feed into almost everything. Transport becomes more expensive, manufacturing becomes more expensive, businesses face higher energy bills. Those costs eventually find their way into the prices we all pay, which means inflation becomes harder to bring down. And if inflation stays higher than expected, the Bank of England has a problem. Because central banks can only cut interest rates if they believe inflation is under control. If energy prices start climbing again, that confidence disappears. So suddenly the market starts thinking, maybe rates will stay higher for longer. And when that happens, bond yields tend to rise. So, yes, the Middle East matters, oil matters, inflation matters. But here's the thing that really caught my attention. I don't actually think that's the whole story. In fact, I don't even think this story starts in the Middle East. Because while everyone was watching oil prices, something else happened here in Britain that received far less attention but could end up being just as important. Earlier this week, the Office for Budget Responsibility published its latest long-term assessment of the UK's public finances. Now, I know that doesn't sound like the most exciting report you'll ever read. I promise I didn't spend my weekend curled up with it. But buried inside it was a warning that I think investors are taking very seriously. The report said Britain is facing growing long-term pressure from an ageing population, rising healthcare costs, increasing pension commitments, and higher defence spending. In other words, the government is likely to need to borrow a lot more money over the coming years. Now, think about that alongside what we've just discussed. Markets are already worrying that inflation could stay higher because of rising energy prices. At the same time, they're being told the government might need to borrow even more in the future. If you're an investor, those two stories reinforce each other. You might reasonably say, if I'm going to lend Britain money for the next 10 years, I want a higher return. Suddenly, those higher gilt yields begin to make a lot more sense. But here's where I think the story becomes genuinely fascinating. Because as I started looking into this, I realised something. I don't actually think this starts in Britain either. In fact, to understand what's happening in the UK today, I think we need to travel almost 6,000 miles away to Japan. For years, Japan has quietly been one of the biggest influences on global financial markets, even though most people never hear about it. To understand why, we need to go back a little. For decades, Japan had one of the lowest interest rate environments in the world. In fact, interest rates were so low that for long periods they were actually negative. Think about that for a second. Imagine lending money and effectively paying somebody else for that privilege. It sounds backwards, but that's the world Japan lived in. Now imagine you're a Japanese pension fund or an insurance company or a bank managing billions of pounds. Would you lend your money to the Japanese government for virtually nothing? Probably not. Instead, you'd start looking overseas. America, Australia, Europe, Britain, anywhere that offers a better return, and that is exactly what happened. Over many years, Japanese investors became some of the biggest buyers of overseas government bonds. That included US Treasuries, European government debt, and yes, UK gilts. In other words, Japanese money quietly became part of the reason governments around the world could borrow so cheaply. Now, fast forward to today, something has changed. The Bank of Japan has started raising interest rates. Japanese government bond yields have been moving higher. They're still low compared to somewhere like the UK or the United States, but compared to where Japan has been for most of the last 20 years, it's still a huge shift. For the first time in a long time, investors can begin earning a more meaningful return without taking money overseas. Now, this is the part that often gets misunderstood. Whenever people talk about the so-called reverse carry trade, they imagine Japanese investors suddenly dumping trillions of pounds worth of foreign assets. Could that happen? In theory, perhaps. But that's probably not how this plays out. Markets don't usually change because everybody rushes for the exit on the same day. Sometimes they change because one of the biggest buyers simply becomes a little less interested. And that's a huge difference. Imagine you've got somebody who buys your house every single month. Then one day they stop. They don't sell your house. They simply stop buying. Suddenly demand falls, prices begin adjusting, And financial markets work in much the same way. If Japanese institutions gradually decide to buy a little more at home, they may naturally buy a little less abroad. That doesn't sound dramatic, but when you're talking about one of the largest pools of capital on earth, small changes can have enormous consequences. Now, let's pause for a second because I know exactly what some of you are thinking. Okay, Paula, but surely if Japan buys fewer UK gilts, somebody else just steps in. And that is a fair question. And this is where I think the story becomes even more interesting because Japan isn't the only country that's changing. Let's talk about China. For years, China was one of the largest foreign holders of US government debt. Its treasury holdings were enormous, but over the last decade, China has gradually reduced those holdings. There are a lot of reasons for that: geopolitics, reserve diversification, domestic economic priorities. The important point isn't why China reduced them. The important point is that one of the world's biggest buyers has become less significant than it once was. At the same time, central banks around the world have been increasing their purchases of gold. Countries are diversifying reserves. They're thinking more carefully about where they hold their wealth. Again, I'm not saying China is causing UK gilt yields to rise. There's no evidence to support that. What I'm saying is something much broader. For years, the world could rely on huge pools of international capital continually buying government debt. Today, that assumption looks less certain. Now, combine that with everything else we've already discussed. Governments aren't borrowing less. If anything, they're borrowing more. Britain needs to invest in infrastructure. Healthcare costs continue rising. An ageing population means higher pension spending. Defence budgets are increasing across Europe. The United States is running enormous fiscal deficits. Europe faces many of the same pressures. Everyone wants to borrow. But the question investors are beginning to ask is, who's going to lend all this money and what return are they going to demand? I'm not suggesting governments suddenly won't be able to borrow. They absolutely will. The bond market isn't saying Britain is going bankrupt. That's not the story. The story is much more subtle than that. The market may simply be saying, if governments want more of our money, they're going to have to pay more for it. And that is a completely different world from the one we've lived in for most of the last 15 years. Think back to the years after the global financial crisis. Interest rates were incredibly low. Central banks launched quantitative easing. They bought huge amounts of government debt. Money was cheap. Borrowing was cheap. Governments became used to financing themselves at historically low interest rates. Investors became used to searching for returns in stocks, technology companies, and eventually crypto. But now, let's look at the world today. Japan is slowly moving away from ultra low interest rates. Central banks are shrinking their balance sheets instead of expanding them. Governments need to borrow more, not less. Defence spending is increasing. Energy security has become a priority again. Inflation has proved much stickier than many economists expected. Individually, none of those stories completely change the world, but together, they might. And I think that's why bond markets matter so much, because bond markets don't usually react to one headline. They react when dozens of different stories begin pointing in the same direction. That's exactly what I think we're seeing today. But if all of that is true, there's one final question we need to answer. What does any of this have to do with Bitcoin? Because if you're sitting there thinking, Paula, this has been fascinating, but I came here because I invest in crypto, don't worry. This is where all of those dots have finally come together. And I think once you see the connection, you'll never quite look at the crypto market in the same way again. One of the biggest changes we've seen over the last few years in crypto is that it doesn't really trade like it used to. When I first got into crypto, almost every price movement seemed to have a crypto explanation. There was a partnership, a new exchange listing, a regulation announcement. Something happened inside the industry. Now, that's only part of the story. Today, Bitcoin reacts to inflation reports, employment data, oil prices, Federal Reserve meetings, government bond yields, even decisions being made by the Bank of Japan. And if you're new to investing, that probably sounds ridiculous. Why should a digital asset that was designed to sit outside the financial system care about Japanese interest rates? The answer is liquidity. Liquidity is one of those words that get thrown around all the time, but it's actually quite simple. When money is cheap, people are generally more willing to take risks. Businesses borrow more, investors buy more, money flows into technology stocks, it flows into venture capital, and eventually it often finds its way into crypto. But when money becomes more expensive, everything changes. If investors can earn a better return lending money to governments, some of that capital naturally moves away from riskier assets. If businesses have to pay more to borrow, they invest less. Consumers become more cautious, economic growth slows. Suddenly, the environment that helped crypto grow over the last decade starts looking very different. Now, does that mean Bitcoin can't perform well in that environment? Absolutely not. Bitcoin has gone through all kinds of macro conditions. But it does mean we need to stop thinking about crypto as though it exists in its own little bubble, because it doesn't anymore. It's part of the global financial system. And once you accept that, the charts start making a lot more sense. This actually reminds me of a conversation that Milkshake Matty and I had inside the Crypto Wolfpack earlier this week. One of our members asked a really simple question. Why isn't Bitcoin reacting the way I expected? Years ago, the answer might have been another crypto story. Instead, that question led us into a discussion about oil prices, then UK gilt yields, then the Bank of England, then Japanese interest rates, then the Federal Reserve. And eventually, we found ourselves talking about liquidity. Not because we were trying to sound clever, but because that's genuinely how markets work today. One headline leads to another, one decision affects another, everything is connected. And that's something we've tried to build into the Crypto Wolfpack over the last year. Of course, we teach trading strategies. Of course, we use automation. Of course, we run signal bots. But one thing that's changed inside the community is how much time we spend asking a different question. Not what is Bitcoin doing, but why is Bitcoin doing it? Because they are two completely different conversations. If all you ever do is watch the chart, you're always reacting. If you understand the environment around the chart, you start anticipating. And they're two very different ways to approach the market. Now, before anyone takes this the wrong way, I'm not saying I've figured markets out. Far from it. Nobody can predict every move. Nobody gets every trade right. What we can do is improve our understanding. And I really believe understanding the environment you're trading in gives you a better chance of making good decisions over the long term. That's really what this channel has become. When I first started Paula Talks Crypto channel, I thought I was making videos about crypto. But now I'm realizing I'm making videos about the world, using crypto as the lens. Because once you start looking beneath the surface, you realize almost everything is connected. Oil affects inflation, inflation affects central banks influence bond markets affect borrowing costs affect liquidity affects Bitcoin, and eventually it affects every single one of us, whether we own crypto or not. Maybe that's the biggest lesson I've learned over the last couple of years. Markets don't usually move because of one event. They move because of dozens of small stories quietly beginning to point in the same direction. And by the time everyone notices, the move has already happened. So the next time you see Bitcoin fall 5%, or hear somebody talk about UK gilt yields, or see a headline about Japanese interest rates, don't automatically treat them as separate stories. Ask yourself, what bigger picture is the market trying to price in? Because I have a feeling that's where the real opportunities are going to come from over the next few years. Not from chasing every headline, but from understanding how these headlines fit together. And I think that's becoming one of the most valuable skills any investor can develop. If you enjoyed today's video, I'd really appreciate it if you hit the like button and subscribe. It genuinely helps the channel and it tells YouTube that you want to see more content like this. And if today's videos made you realise you want to understand markets at a deeper level, Milkshake Matty and I would love to welcome you into the Crypto Wolfpack. Every day we're having exactly these kind of conversations, connecting macro, crypto and market structure instead of looking at them in isolation. Whether you're brand new to investing or you've been around for years, it's become a really supportive community of people who simply want to understand the markets better together. And if you're interested in automating your trading, we've put together a completely free TradeBot Pro course. It takes you from beginner to having signal bots connected to your exchange in around 30 minutes. And you'll also get a free 14-day trial to test everything for yourself. You'll find both links in the description below. Thank you so much for watching, and I'll see you in the next one.